enthusiastic voice. Are you ready to make your money work for you? Do you dream of achieving financial freedom and living life on your own terms? Well, you're in the right place, because this video is tailored just for you. Hi there, I'm Jack, and I'm here to guide you through the exciting journey of mastering your finances and building a brighter financial future. Today, we're diving into one of the most talked about topics in America: investment strategies that actually work. By the end of this video, you'll gain a crystal clear understanding of the most popular investment options available in the US. Learn how to weigh their pros and cons and figure out which investment channel aligns best with your financial goals. Whether you're just starting or looking to diversify your portfolio, this video will equip you with practical insights that you can act on immediately. But that's not all. Along the way, I'll share real statistics from trusted sources like Forbes and CNBC, so you know you're getting accurate, up-to-date information. If you're serious about taking control of your financial future, make sure to hit that like button to let us know you're enjoying the content. And don't forget to share this video with friends and family who might benefit from these insights. Subscribe to the channel and hit the notification bell so you never miss a single tip that could change your financial life. Let's get started and make your money work for you. Now I will tell you a story. Meet John, an ordinary office worker earning an average salary. Just 5 years ago, John was living paycheck to paycheck, feeling stuck in the endless cycle of bills and expenses. Like many Americans, he had dreams: owning a home, traveling the world, and creating a secure future for his family. But those dreams felt out of reach. One day, while scrolling through articles online, John stumbled upon a piece about the power of smart investing. Intrigued but skeptical, he decided to take a chance. He started small, dedicating just 10% of his monthly income to learning about and investing in the stock market. With no prior experience, he made mistakes, but he didn't give up. Instead, he treated every setback as a learning opportunity. John's breakthrough came when he began following a simple but powerful strategy: diversify his investments and think long-term. He researched ETFs, dabbled in dividend-paying stocks, and even explored index funds. 3 years later, John looked at his portfolio and realized he had doubled his initial investment. Fast forward to today, John is no longer the stressed-out worker he used to be. He recently bought his first home, upgraded to a comfortable car, and is now planning his dream vacation to Europe, all while knowing his investments continue to grow. Now, let me ask you, do you want to be the next John? What if you could make your financial dreams a reality by starting your investment journey today? In this video, I'll guide you through the most popular investment options available in the US, show you how to evaluate their risks and rewards, and help you choose the one that fits your goals. Whether you're a complete beginner or looking to fine-tune your strategy, these insights will empower you to take action. Let's dive into the key investment options and uncover the secrets to financial freedom. Here are the popular types of investment assets in the US. 1. Stocks. The basics of stock investing, 400 words. What are stocks? Stocks represent partial ownership of a company. When you buy a stock, you're essentially purchasing a small slice of that business, known as a share. The stock market is where these shares are bought and sold, allowing individuals to invest in companies they believe will grow over time. Major stock exchanges like the NYSE and NASDAQ facilitate these transactions, and their daily activities often reflect the economy's health. Advantages of investing in stocks: high earning potential. Over the long term, stocks have consistently outperformed other investment options like bonds or savings accounts. Some stocks yield impressive returns, turning modest investments into significant wealth. Liquidity. Stocks can be easily bought or sold, offering investors the flexibility to access their money when needed. Disadvantages of investing in stocks: high risk. Stocks are volatile and can lose value quickly due to economic downturns, poor company performance, or market crashes. Time and knowledge demands. Successful stock investing requires a deep understanding of market trends, company fundamentals, and sometimes even global events. Regular monitoring is essential to make informed decisions. A real-life story: take Sarah, for example, a school teacher with no financial background. Inspired by success stories, she started investing in stocks using a popular trading app. In the first year, she made significant gains by investing in tech stocks, doubling her initial investment. However, during a market downturn, Sarah's lack of diversification and reliance on a single industry caused her portfolio to lose 40% of its value. While she eventually recovered by broadening her investments and learning from her mistakes, it was a costly lesson. On the flip side, there's Kevin, an accountant, who started with small investments in index funds and blue-chip stocks. His disciplined approach of reinvesting dividends and focusing on long-term growth helped him grow a stable portfolio that continues to pay off in retirement. Resources for beginners. If you're new to investing, start with these tools. Websites: Investopedia, Morningstar, and MarketWatch for daily insights and tutorials. Books: The Intelligent Investor by Benjamin Graham and A Random Walk Down Wall Street by Burton Malkiel. Courses: Online platforms like Coursera and Udemy offer beginner-friendly investment courses. Apps: try Robinhood, E-Trade, or Fidelity for user-friendly stock trading. With the right knowledge and strategy, stocks can be a powerful tool for building wealth. Let's move to the next investment option. 2. Bonds, a stable investment option. 300 words. What are bonds, and how do they work? Bonds are essentially loans that you, as an investor, provide to a government or corporation in exchange for regular interest payments and the return of your principal when the bond matures. Governments often issue bonds to fund projects like infrastructure, while companies may issue them to raise capital. Bonds are typically considered safer investments compared to stocks because they offer a fixed income and have priority over shareholders if the issuer faces financial trouble. Advantages of investing in bonds: safety and stability. Bonds are less volatile than stocks and are often seen as a safe haven during economic uncertainty. Steady income. Investors receive regular interest payments, making bonds an excellent choice for those seeking predictable income streams. Disadvantages of investing in bonds: lower returns. While safer, bonds typically offer lower returns than stocks over the long term. Inflation risk. Rising inflation can erode the purchasing power of the fixed income you receive from bonds. A real-life example: consider Mike, a retired teacher who wanted a stable income during his retirement. He allocated a portion of his savings to government bonds, which provided him with consistent interest payments. While Mike didn't see the dramatic growth that stock investors might experience, his bond investments gave him the peace of mind to cover his living expenses without worrying about market volatility. In contrast, Anna, a young professional, invested in corporate bonds from a startup. Although these bonds promised higher returns, the company faced financial difficulties, and Anna received only part of her investment back. Her experience highlights the importance of assessing the creditworthiness of bond issuers. Bonds are a reliable way to diversify your portfolio and reduce risk. Let's explore the next investment option to balance your strategy. 3. Real estate. Building wealth through tangible assets. 500 words. Popular forms of real estate investment. Real estate has long been a favorite investment option for those seeking to build wealth and generate passive income. Here are the most common ways people invest in real estate. Rental properties. Buying residential or commercial properties to lease out for steady monthly income. Land investment. Purchasing undeveloped land in areas expected to grow in value over time. House flipping. Buying undervalued homes, renovating them, and selling at a profit. REITs, real estate investment trusts. Investing in real estate through stocks, offering a hands-off way to benefit from property growth. Advantages of real estate investment. Tangible asset. Unlike stocks or bonds, real estate is a physical asset that you can see and use, providing a sense of security. Appreciation in value. Historically, property values tend to rise over time, offering potential for long-term capital gains. Passive income. Rental properties generate consistent cash flow, making them an excellent source of passive income. Disadvantages of real estate investment. High initial capital. Real estate often requires a significant upfront investment, including down payments and closing costs. Low liquidity. Selling a property can take months, making it less liquid than stocks or bonds. Market risks. Property values can drop due to economic downturns or changes in local markets. A real-life experience. Let me tell you about Lisa, a young entrepreneur who decided to invest in real estate. Lisa purchased a duplex in a growing suburb with the intent to live in one unit and rent out the other. Over 5 years, the rental income not only covered her mortgage, but also provided extra cash to reinvest. Additionally, the property's value appreciated by 30%, allowing her to sell it at a substantial profit when she decided to upgrade. On the flip side, her friend Mark tried his hand at house flipping. He bought an older property with the goal of renovating and selling it within 6 months. Unfortunately, unexpected repairs and a cooling housing market delayed the sale, eating into his profits. Mark's experience highlights the importance of planning for contingencies and understanding market trends. Tips for aspiring real estate investors. Start small. Consider investing in REITs if you're new to real estate and want to avoid large upfront costs. Research the market. Study local trends, job growth, and population increases to identify high potential areas. Budget for unexpected costs. Always set aside extra funds for maintenance, repairs, or unforeseen expenses. Leverage professional help. Work with realtors, property managers, and contractors to make informed decisions. Real estate offers a unique combination of stability, growth, and income potential, making it an excellent option for diversifying your investment portfolio. Let's now move on to the next exciting investment strategy. 4. Mutual funds. Diversify your investment portfolio. 300 words. What are mutual funds and how do they work? A mutual fund is a pool of money collected from multiple investors, managed by a professional fund manager. This fund is then invested in a diversified portfolio of assets, including stocks, bonds, and other securities. By investing in a mutual fund, you gain access to a wide range of investments without the need to select and manage individual securities yourself. When you invest in a mutual fund, you buy shares that represent your portion of the fund's holdings. The fund manager uses their expertise to select assets that align with the fund's goals, whether that's growth, income, or a mix of both. Advantages of mutual funds. Diversification. Mutual funds spread investments across various assets, reducing the risk associated with holding a single stock or bond. Professional management. Fund managers handle the research and decision-making, making mutual funds a convenient option for beginners or busy investors. Disadvantages of mutual funds. Management fees. Mutual funds charge fees for their professional services, which can eat into your returns. Performance variability. Not all mutual funds outperform the market, and some may yield lower returns than expected. Tips for choosing a mutual fund. Understand your goals. Identify whether you're seeking growth, income, or a balanced portfolio. Research performance history. While past performance doesn't guarantee future results, a strong track record can be an indicator of a well-managed fund. Compare fees. Look for funds with low expense ratios to maximize your returns. Use trusted resources. Websites like Morningstar and Vanguard offer detailed comparisons of mutual funds. Mutual funds are a great way to diversify and benefit from expert management, making them an ideal choice for long-term investors looking for simplicity and reduced risk. Let's explore the next investment option to expand your financial knowledge. 5. ETFs, exchange-traded funds. The modern way to invest. 300 words. How ETFs compare to mutual funds. ETFs and mutual funds are similar in that they both provide diversification by pooling money to invest in a variety of assets. However, there are key differences. Cost. ETFs typically have lower management fees than mutual funds, making them more cost-effective. Flexibility in trading. Unlike mutual funds, which are priced once a day, ETFs are traded like stocks on an exchange, allowing investors to buy or sell them at market prices throughout the day. Management style. ETFs are typically passively managed, tracking an index, like the S&P 500, while mutual funds are typically actively managed, aiming to outperform the market. Advantages of ETFs. Low costs. With expense ratios typically below 0.1%, ETFs are a cost-effective way to invest. High liquidity. Since ETFs are traded on exchanges, they can be easily bought or sold at any time during trading hours. Diversification. Like mutual funds, ETFs spread their investments across a variety of assets, reducing risk. Disadvantages of ETFs. Market risk. ETFs are subject to market volatility, so their value can fluctuate significantly in the short term. Not ideal for all investors. Investors looking for actively managed strategies or personalized portfolios may not find ETFs suitable. Are ETFs right for you? ETFs are best suited for people who want to invest with little overhead, are hands-off, and are comfortable with market fluctuations. For example, a novice investor can use ETFs to gain access to broad indexes like the S&P 500 without needing in-depth knowledge of individual stocks. When choosing an ETF, consider the following tips. Consider the expense ratio. Choose an ETF with low fees to maximize your returns. Know the index. Know what the ETF is tracking and make sure it fits your investment goals. Check the liquidity. Choose an ETF with high trading volume to ensure easy buying and selling. ETFs are a versatile wealth-building tool that combines the benefits of diversification, liquidity, and cost efficiency. Here are the other types of investments. 6. Exploring other investment options. 400 words. Beyond stocks, bonds, real estate, and funds, alternative investments offer unique opportunities to diversify your portfolio. Let's dive into 3 popular options. Cryptocurrency. Cryptocurrencies like Bitcoin, Ethereum, and others have gained massive attention in recent years. How it works. Cryptocurrencies are digital assets that use blockchain technology to ensure secure and decentralized transactions. Investors can trade them on exchanges like Coinbase or Binance. Advantages. Cryptos have high growth potential and offer decentralized transactions beyond traditional banking. Disadvantages. They are highly volatile, with prices capable of swinging drastically in short periods. The market is also largely unregulated, posing risks of fraud and loss. Pro tip: only invest money you can afford to lose and focus on reputable cryptocurrencies with established track records. Precious metals, gold, silver. Precious metals have been a timeless investment, especially during economic uncertainty. How it works. Investors can buy physical gold and silver, bullion, coins, or invest in ETFs and mining stocks. Advantages. Precious metals are considered a safe haven investment, retaining value when stocks or other assets drop. Disadvantages. They don't generate passive income and can be expensive to store securely. Pro tip: use gold and silver as part of a diversified portfolio, not as standalone investments. Investing in yourself, perhaps the most overlooked but impactful investment, is in your education, skill, and personal development. How it works. This could include taking courses, earning certifications, attending workshops, or developing soft skills like communication or leadership. Advantages. Knowledge and skills yield long-term benefits like career growth, increased earning potential, and personal satisfaction. Disadvantages. Requires time, effort, and sometimes significant financial investment. However, the returns often outweigh the costs. Pro tip: identify areas where improvement can lead to tangible career or personal growth, and commit to continuous learning. Making the right choice. For example, Sarah, a teacher, decided to invest in herself by earning a certification in digital marketing. This not only doubled her income through freelance projects, but also gave her the confidence to transition into a new career. Meanwhile, her brother James diversified his portfolio with gold and cryptocurrency, providing a hedge against inflation and market fluctuations. These alternative investments, when approached strategically, can provide growth, security, or personal enrichment. Choose what aligns best with your goals, and remember, diversification is key to long-term success. Investment strategies: a comprehensive guide to building wealth. 500 words. Investing successfully isn't just about picking the right assets or chasing the latest trends. It's about developing and adhering to a strategy that aligns with your financial goals, risk tolerance, and life stage. Here's a detailed guide to the key principles of a solid investment strategy. 1. Define clear financial goals. The first step to successful investing is knowing why you're investing. Short-term goals: saving for a vacation, building an emergency fund, or buying a car. Medium-term goals: purchasing a home, funding higher education, or starting a business. Long-term goals: retirement planning or creating generational wealth. Having clear objectives not only gives you direction, but also helps determine the right investment vehicles. For instance, high-risk investments like stocks may be ideal for long-term goals, while safer options like bonds work better for short-term needs. 2. Match investments to your risk tolerance. Every investment carries risk, and understanding your comfort with risk is crucial. Conservative investors prefer stability over high returns. Options like bonds, dividend stocks, or money market funds are ideal. Moderate investors, willing to take some risks for balanced growth. A mix of stocks, ETFs, and bonds can work well. Aggressive investors focus on maximizing returns and can tolerate volatility. High-growth stocks, real estate, and cryptocurrencies may be suitable. Knowing your risk tolerance ensures you don't panic during market downturns and helps you stick to your long-term strategy. 3. Diversify your portfolio. The adage, "Don't put all your eggs in one basket," applies perfectly to investing. Diversification involves spreading your investments across different asset classes, industries, and geographies. Example portfolio: 50% stocks, 30% bonds, 10% real estate, and 10% alternatives like gold or cryptocurrency. Diversification reduces the impact of a poor-performing asset on your overall portfolio, making it a cornerstone of risk management. 4. Practice patience and discipline. Investing is not a get-rich-quick scheme. The most successful investors stay committed to their strategy, even during market turbulence. Avoid emotional decision-making, such as panic selling during a downturn or buying into a bubble. Implement disciplined habits like dollar-cost averaging, investing a fixed amount regularly to reduce the impact of market volatility. 5. Continuously learn and stay informed. Markets and economies evolve, and so should your knowledge. Follow reputable financial news outlets like CNBC, Bloomberg, and the Wall Street Journal. Take courses on platforms like Coursera or Udemy to understand advanced investment strategies. Stay updated on tax laws and retirement policies, as they can significantly impact your returns. The importance of a financial plan. No investment strategy is complete without a well-structured financial plan. Start by creating a detailed budget to determine your disposable income for investments. Set milestones to measure progress and adjust your strategy as your financial situation or goals change. Rebalance your portfolio annually to ensure it stays aligned with your risk tolerance and objectives. Consider Emily, a marketing professional. She began her journey by setting a goal to retire by 55. Emily diversified her investments into index funds, real estate, and bonds. Despite market downturns, she stayed consistent with her contributions and educated herself on new opportunities. Today, Emily is on track to achieve her goal thanks to a disciplined, goal-oriented strategy. Investing is a marathon, not a sprint. With a clear roadmap, patience, and a commitment to learning, you can turn your financial goals into reality. Remember, the key to building wealth is consistency and resilience, no matter the market conditions. Thank you for joining me on this journey to explore smart investment strategies. We've covered a lot today, from understanding stocks, bonds, and real estate to exploring mutual funds, ETFs, and alternative investments like cryptocurrency and personal development. The key takeaways? Define your financial goals. Match investments to your risk tolerance, diversify your portfolio, and stay disciplined while continuously learning. By applying these principles, you're not just investing money, you're building a future of financial freedom and security. Now it's your turn. Start your investment journey today. Take the first step by applying what you've learned and share your progress with me in the comments below. If you found this video helpful, don't forget to like, share, and subscribe to the channel for more valuable insights.